10:30, and then we're going to get started with our ratios analysis. For anybody who's live with us, if you have any questions, just go ahead and enter those in the chat. Christy's on board to help me with questions, and I'm on board to help her. So I'm going to be doing the ratio analysis, and Christy's going to be taking us into how to use Finagraph with your clients. And Joy is going to pick up from there and show us the next generation of Finagraph. Can everybody hear me all right? Can you try raising your hand, our viewers out there, and let me know if everybody can hear all right? Almost everybody. And wonderful. Melissa? Yes. Mary Margaret? Okay. All right. Great. Thanks. I think everybody's got it. All right. Oh, Tom. Welcome on, Tom. Can you raise your hand if you can hear me? And if you have any questions, just hit the Q&A, and Christy will help out while I'm talking. All right. So we were just talking about how it's the end of the year, and we've got everybody sort of wrapped up, or we're just wrapping everybody up and looking at how next year we want to make more money, do less work, and sort of set our goals with our clients. And there's always hopefully the raising of the rates every year, something that you consider doing, how you can make your services better for your clients, provide more value with less time. All those things that sound beautiful, and this is all about really something very, very practical at almost no cost that you can do that's highly valuable for your client. And so let's dive right in, assessing the health of a business. And this is brought to you, I want to say, in part by Finagraph, and I want to thank Finagraph for their support. So why would we want to be doing these ratios? What is the point is where I sort of want to get started here. And that's to answer right from the get-go some very key questions like, should I be taking on a particular client? Can the company generate enough money to pay its bills? Like, will your bill get paid? And with the money that's there, is it coming from debt that they borrowed, or from money that the owners put in? Or is the money there because of profits? And that's going to tell you how long that company is going to be around and what state of business they're in. And then the next question might be, does the company have too much debt already, or is there room to borrow? And then ultimately, can the company afford your services? These are the kinds of questions that you can answer very quickly just by doing these ratios. And I'm going to focus on really the first couple of ones. Is there enough money in the company to pay your bills? And where is that money coming from? So that's going to help you to decide if you want to take on a new client. And let's talk just very briefly about what a ratio is. I know it sounds really basic, but the example we used in the training was a couple of weeks ago at the Finagraph offices was cooking. And a good ratio for cooking rice is usually 1 cup of rice to 3 cups of water. And it's not necessarily that the rice is bad or the water is bad or one is good or better than the other, but that it really takes a balance of both. The right combination of the water and the rice in order to make your rice turn out well. Otherwise, it's fluffy and gross. And anyway, this is this is what ratio is all about. So it's not necessarily that you're trying to get to like a super high number or a super low number. It's about having the right balance. And so in this example here, the white to red is a good amount of ratio space, but this letter in the lettering in the middle of the box, answering a question by explaining a relationship, that's like way too small. It's the wrong ratio of the font to the white. So you're just all about getting the right balance. And the first one I want to talk about is the current ratio. It's just super fast. Can the company pay its bills? Will your bill get paid? This is about this year right now. Is there enough money in the bank to pay the bills? And so I hope you've all had a chance to download the supplemental materials. They are, I'm going to screen share them with you here. A balance sheet and a profit and loss report, which I've copied most into the presentation here. So we're looking at Craig's Design and Landscaping, and this is just right out of QuickBooks Online. So we all know what this looks like. We're used to them being formatted this way. So let's look. I'm going to take this back over to my PowerPoint here. And are you all seeing the PowerPoint now? Yeah. All right. So looking at this balance sheet, you could walk through this with me really easily and find out what the current ratio is for this company. And again, you're answering the question, is there enough money to pay the bills? You know, before you take on the client, do they have enough money to pay their bills? So this company has $7,000 in their checking account, and they have, oh, sorry, I moved forward there. They have $3,000 in their savings account, and they have some inventory and some receivables. So the receivables, we're assuming our receivables are money that's really ready. The product's been sold, the contract's been made, and this money is truly, we're going to see this coming into the business. So this is money that we can count on. And then we're looking at the inventory. This should be inventory that's ready to be sold. Okay, so our total current assets for this company is $15,000. So I'm going to just write 15 here. All right, and I'll look at our balance sheet and let's go through the payables. So we have bills that need to be paid. And notice there's a $5,000 MasterCard debt there. So we've got $5,000 on the credit card and we owe $1,000 in sales tax. So the total current liabilities, these are things that need to be paid within the next 12 months. This is current debt is $10,000. So we've got $15,000 in like cash and money coming in and stuff get ready to be sold. And we have $10,000 in bills that need to be paid, credit cards, sales tax. And we get this ratio by dividing the current assets by the current liabilities. And when we do that, we get 1.5. So 15 divided by 10 gives us 1.5. And that means that this company has $1.50 in the bank for every dollar of debt that it has. So it has $1.50 for every dollar of debt. And I'm going to pause in case there's any questions that I can answer here. Is everybody with me?
Seems so.
All right. Thank you, Christy, for
Sure.
keeping on track of that for me. Okay, so this company has $1.50 in money and receivables to pay its current bill. So there's some wiggle room there, right? And you might feel that there's some cash to pay your bill. Now let's look at a more thorough, more careful, conservative look at the same balance sheet. So we're going to keep the checking and the savings account in here and the receivables. Again, we're assuming those are under contract, they're going to be received, but we're not going to count the inventory. This is called the quick or acid test. And it, like I said, it's more conservative and it's really about the short term and whether this company has money right now to pay its short-term obligations. So the current ratio is looking more at like the next 12 months, and the quicker acid test is really looking at this 90-day period, the next 3 months. So you're looking at what is the situation really right at this moment, because you don't know for sure if that inventory is going to get sold, right? So this is much more conservative. And if we take the 4,000 out of here, then we're going to have 11,000 in our assets, and we still have the same amount in liabilities. So the quick ratio goes to 1.1. So we go from 1.5 to 1.1. when we pull out the inventory. And that's meaning that we have $1.10 to pay for every dollar of debt. So that's getting really tight, right? And again, this is something you can do pretty quickly. It's one number divided by another, and it'll help you to decide whether or not you should be taking on a new client. Anything I can expand upon? Okay, I'm going to keep going because you get to do it now. Yay! It's homework time. All right, so yeah, this is just you have the balance sheet there, and I'm going to write in what the current ratio and the quick ratio were for 2015. That's what we just did. So now you can do 2016. So you're going to take the current assets and put them there, and the current liabilities and put them there, and then determine what the 2016 ratio is, and do that both for the quick and for the current. And I'll just pop up the screen. Yeah, this is what you're looking at. So we did 2015, and you're doing 2016 right here. So I'm just going to give you a second. I'm sure you'll notice what the difference is right away. All right, and this is a recording, so you could always just like pause and see it later. So in 2016, we're showing that the
we have a blank screen, Shelly.
Oh, we have a blank. Thank you so much. My screen sharing is paused. It says, okay, resume share.
There. So now we're looking at the balance sheet and profit and loss.
Okay, well, let's go back to here.
There we go.
Awesome. Okay, so in 2016, we had the same amount of, whoops. Hold on just a second. I lost my window. Okay. Chrissy, is same amount in current assets, right, in 2016?
Yes.
Okay. And then the current liabilities, though,
Went down to 5.
Yeah, went down to 5. So dividing 15 by 5, I don't know if I needed to. I have a calculator out, but I think we can all feel pretty comfortable about doing that one, right? Okay, so that gives us a current ratio of 3. So our numbers improved significantly between 2015 and 2016. And then same thing with the quick ratio. Let's see what happened there. Again, we have no change, right, in the assets.
No, the assets for the quick.
Mm-hmm.
So cash and accounts receivable was 11.
Right, and that's the same amount that we had in 2016.
Yes.
Or 2015.
Yes, that's correct.
Okay. And but what's different is that we had changed the current liabilities down to 5, from 10 to 5. So our quick ratio, dividing 11 by 5. Again, I think we're good with the math. 5 goes into 10, 2, and into 11, 2.2. So our quick ratio in 2015 was 1.1. In 2016, it improved. It went up to 2.2. And this is something that was done because of the distribution of debt. And this is an important thing that you can, I want to be able to help your clients with, is really be able to help manage debt. And debt isn't necessarily a bad thing. It's necessary in order to grow. company, but we do need to manage the debt and keep the short-term debt equivalent with the short-term assets, and long-term debt to be equivalent with long-term assets. And what that means is that we wouldn't want to use the credit card, for example. In our case, it was the MasterCard, right? We had a MasterCard that had 5,000 on it. We wouldn't want to use a credit card to buy a car, for example, because the credit cards do in the short term. The car is a fixed asset. It's going to last for the long term. So misfinancing is usually what makes these ratios easiest to adjust and fix. That's like your quickest fix. And that's going to make the company more secure, and it's going to make it a better bet for you to spend your time working with. So it's a quick little thing that you can do these ratios and then look instantly for misfinancing. That's most likely what the problem is. Now let's look at debt to equity. So this is, can the company take on more debt? So does it have too much debt already, or can it take on some more debt? So first we were looking at like, how do we have enough money to pay our bills? And now we're looking at, okay, do we need to, can we borrow money? So again, I'm looking at the balance sheet, and I went ahead and just went straight over to the current liabilities, and those are 10,000 there. And notice the note, which is 14,000, and I'm looking at 2015. So we have total liabilities of 24,000. All right. And then we look at the equity, which I'm looking at the spreadsheet over on my other screen here, and I'm just pulling the, the 5,000 off the bottom line there. I know we don't really need to split it out. We've got retained earnings, we have net income, but really at the bottom line is it's 5,000. So we take our 24 and divide it by 5, and we get a ratio of 4.8. What that means is that the company has borrowed $4.80 for every $1 that it's either earned through profits or the owners have put in. So it's borrowed a lot of money, the 24,000, in compared to what they've either left in the company or what they've what the owners have invested themselves. And this number is too high for your typical banker. It's really that doesn't leave you room for borrowing. So you don't want any more than 1.5 usually. And now we're getting into like, well, what is a good ratio exactly? And that's where the Finagraph program starts really saving a lot of time. So we're gonna have a chat. We're gonna practice this one. And then we're going to recap, and then we're going to look at the Finagraph. So 2015, the ratio was 4.8, right? And then in 2016, did we have a change in our ratio? And that is the question. We had 24,000 in our total liabilities. That didn't change. But the equity changed. Went down from 5,000 to 2,000. And when we divide 24 by 2, we get 12. So now we've moved from 4.8 to 12. And that's because the owners pulled the equity out of the company. They pulled out 5,000. So that again is telling you how highly leveraged this company is, whether there's room to borrow more money. It's really impossible for just about any business to grow without borrowing. So if you're looking to make a long-term investment in a client, You want one that has the ability to be able to borrow so that they can take on bigger contracts and move ahead in the business. So this is something to really consider as you're making that investment with the client, because it's a long-term relationship. You're with them like till they die, right? It's true. It's impossible to fire them. All right. So now, once you've taken on a client, and now you might want to help them to make more money, right? And this is one margin, one ratio that you really can keep an eye on really easily. It's right in sort of in your corner. Is sales and cost of goods sold, where you're making sure the inventory is right as it's running through your accounting system, so that the cost of goods sold is accurate, and you're now able to help your customer decide if they are charging the right amount for their product, so that their gross profit is as high as other folks in their industry. And the formula is simply the gross profit divided by the sales. Those two numbers right there. And that gives us the percentage of money that's made for every dollar of sales. And this is when we were in our class and everybody's like, yeah, this is cool. I'm starting to get a little overwhelmed. And I said, let's move on to the Finagraph. Because it's going to do this for us, and then it does the next thing for us. And then after a little while, you're like, wow, I could spend about 30 seconds with the Finagraph and get all of this done at once. So I want to just speak briefly to the net profit margin, which is another very important ratio for you to look at with your customers. And when you get into the Finagraph, there's going to be 14 ratios in there. The gross profit margin and the net profit margin are two that you probably want to start out focusing on with your existing clients. The gross profit margin, which is telling you whether or not they're getting the right deals from their suppliers and charging the right amount to their customers. And then the net profit margin, which is really going to tell you whether or not the business is profitable, and you can work backwards into it to figure out whether or not they have enough money to pay your bill. So if you want to put them in your tier 1 package and you want them to be $8,500 a year, you would add that $8,500 onto their operating expenses and see if they're going to be able to make enough profit to pay your bill. So you can use this to work backwards through various scenarios, and it's a very powerful tool. So folks, we are going to skip the analysis. You get to have this as a handout and practice to your heart's desire. Go through a quick little pop quiz and then head over to Christy, who's going to show us how to do this in the Finagraph. So just to recap, if you wanted to know if a company could generate enough money to pay its bills, you would look at the current ratio. So Christy's going to show us that. Do the owners invest in the company? That's the debt to equity ratio. Can the company generate enough money to pay its bills even if it doesn't sell its inventory? That's going to be the quick test. Are the company's selling prices high enough? That's the gross profit. And then how effective is the company at making money? And that's your net profit ratio. So lots of fun. Thank you very much for learning ratios with me briefly, and I'm going to take you over now to Christy. So,
all right. Are we all set?
Yeah.
Okay, I'm going to steal the screen from you.
Awesome.
Okay. Okay, can everyone see my screen? Raise your hand if you can see it. Everyone's good? Okay. So I have set up a demo company that I use quite often when I'm showing different apps. This is actual live data. And so this is not Craig's Landscaping. This is a company that I've set up using actual data. It is a cleaning company in real life, but I have redacted any identifiable information. So we can actually see Finagraph in motion. So in order to set Finagraph up typically you would look for it at apps.com. So you would just search for Finagraph. And as we all know, when we go to apps.com, we can search by, the type of thing we need, the industry, and we can add it from here. Finagraph actually just has us go right to their website. So because I already have a Finagraph account, I'm already logged in. And we're going to go ahead and actually start from the very beginning. We're going to add this business in. So this is my dashboard. This is where I can see all of my clients and if I need to run a new Finagraph for any of them. I'm going to add this one here, and I'll walk you through how easy this is to set it up. This is where it's going to pull location. And then here's the NAICS code that we talked about in the What's New conference. So I can type in the number if I know it, but I can actually just type in cleaning and it'll start to pull things up. Okay, those aren't really, so maybe I'll say janitorial service. Perfect. So it's going to pull the actual NAICS code, and this is where it's going to pull industry averages for you. So it's really important to try and get this as close as possible. And you can also click on this here, and it'll start you from very basic and drill you down. That's another way to do it. So I'm going to hit save. And then once that's done, it's going to ask us what type of accounting software that we're using. So I'm going to click New Finagraph. And I'm going to, let's see, I need to change it because it automatically defaults to the desktop, but I'm using online. So what I want to do is I want to change it. And here you'll see just exactly what you can connect up with. You can connect up with Excel, Dynamics, Peachtree, desktop, online, beta edition for Sage 50 and 0. So some of these are still in beta, but there are more. It's more than just for QuickBooks Online for those of you who aren't excited about that. So this file happens to be in QuickBooks Online. So I'm going to go ahead and pull it from QuickBooks Online. And then there it goes. And then I'm going to click Save. And now it says connect. So this is a step, if you're working in QuickBooks Online with third-party apps, that's probably going to be very familiar to you. It's going to pull up that little authorization screen to make sure it's okay. And it's also going to ask you which firm you want to connect to. So if you do use QBOA, all of your clients are going to be listed here. And you just have to search for the one that you want to connect it to. So I'm going to hit confirm. I'm going to hit authorize, and it's going to do its thing. So now what Finagraph is going to do is it's going to, knock on the back door of my file, and it is going to start pulling all the data from my my balance sheet, my profit and loss, and I believe it pulls direct. I can't remember what they said at the Shelly. Do you remember what they said at the conference we just had about as far as how deep they drill down?
No.
It goes a year back.
A year back. And then is it to the transactional level, or is it like, is there personal identifying information that comes into Finagraph, or is it?
I honestly don't know the answer to that question.
Okay.
We can find out though.
Okay. So they advertise when they're showing this part that this is where you would go get a cup of coffee. And it's true. I mean, I've literally timed this. I've been able to go get a cup of coffee, come back, and it's done. And it's so much more than just, calculating one ratio at a time. As soon as so it's finished pulling everything from QuickBooks. Now it's throwing it into the engines at Finagraph to give us some data that's really readable, and we can really dig in and see how this company is doing. And since I've never hooked this up before, I have no idea how it's doing. So it should be pretty interesting to see. It could be good, it could be bad, it could be ugly, who knows? Oh, who do you got, Shelly? I can't hear you.
This is my son's dog, Bucka. I thought I'd say hi since we had a minute.
I've got my cat laying right next to me, sitting on top of my notebook, so I can't do anything.
Yeah.
Can't write anything down.
The animals are so helpful, aren't they?
Yes.
Like, yeah.
He's a stickler for real work.
Yeah. I did.
Has everyone figured out the gross margin yet on that sheet that Shelly gave you?
Yes, that's what people should be doing now. I was trying to figure out what we'd do with this little bit of time here.
Compare it with what Finagraph comes up with.
I think I figured out how to make it so people can talk too.
Did you? Is there any good comments or questions going on right now in the chat or in the Q&A?
I don't know. Somebody says they can't see me. You can see me now though, right?
Okay, here it goes. It's almost done.
I know you said it would hang a little bit. That wasn't too bad.
No, that's literally enough time to pour yourself a cup of coffee, put a little cream and sugar in it, come sit down, have a sip, and then it's ready to go.
And think about what you're going to be doing. I remember you said that you provide this for your tier 1 clients, whether they like it or not.
Right. And most of the time, I'm not going to lie, they have no idea what they're looking at. But that gives me an opportunity to sit with them in a screen share, much like we're doing right now, and walk them through it. Okay, so the first thing to notice is that it breaks down by month, quarter, and year. So all of these, right now we're in a month to date. So it's pulling data from the past 12 months, and it can pull by quarter here, or it can pull and do a year-over-year comparison, just depending on what's in there. So I only have data as far back as 2015 in here. So I'm going to walk you through the month over month. So essentially, here's the health. Here's, this is in thousands, by the way. So it's income, expenses, and expenses before, interest, taxes, depreciation, and amortization. Here, my friends, are our ratios that we just sat and calculated by hand. So the nice thing to note right away is that currently I'm at 1.53, and it's showing the industry average is 1.4. So we have a green go check mark. We're doing great. That's fantastic. And we'll do the same thing for each of these. So as you hover over them, it's going to tell you what the industry average is. Now, let's say you weren't sure how to explain the current ratio or maybe how to fix it. You can actually hover over these different ratios, and it'll give you an explanation why you should care about it, possible causes, and possible solutions, which I find to be the most helpful because I can do the math and I can calculate a ratio, but most of the time I have no idea what I should suggest to fix it. This at least points me in the right direction. And then when I see something like a red flag here at gross margin, let's see, gross margin is 100% typically for my industry. Now, this could just be because I've decided to call cleaning supplies COGS, so you may need to check the setup of your file. There could also be issues with, having long-term debt showing up under short-term debt. Maybe they set it up incorrectly, and we just need to go back in and figure out what each debt or asset is and make sure it's going under current or long-term. So those are some things to look at first. But, okay, gross margin, here's what it means, here's why I care. Here's some possible reasons it could be bad. So this gives me a starting point to do some talk, to chat about these things, to make me look like the professional. And then here are the solutions that I'm suggesting. And maybe none of these work for this particular client, but at least you can go in, and rather than just being the person who's sending them a report every month, you can actually send an email with it and say, here's some things I noticed, here's some ways I think we can fix it. Let me know your thoughts. And then we also have our risk indicators. This is more or less, I think, for the bank. This company is actually doing really, really well. So I'm pretty pleased with my demo company here. Here are some, really quick, here are things we're doing good, show me more. This will actually take you down to where where it's pulling that information and why. So because your net margin was better than the industry average of 10.1%, you earned that much more cash. So it gives you specifics even. It's great. It'll also, give you some more information to chat about your client with. Here's things that we need to work on: our AR days, our gross profit margin. So we already kind of covered that. So as we continue to scan down, here's some more asset ratios, inventory turnover, if they have inventory, AR turnover, AR days, 19.99. So essentially what that means is that the industry average for collecting on invoices is 10 days. We're collecting them in 20. So we may want to look at processes here. What can we streamline? Can we turn them on to QuickBooks payments or some sort of merchant services so they're not waiting on a cash or a check? Maybe we can ask for payment in advance, switch to a flat fee structure or something like that. Then there's cash impact maps that just basically says so for instance, this AR days. If your AR days were at average, we'd have almost $800 more. So this kind of shows you how, management that could create better results is having an impact on your cash flow. Here's your debt ratios, working capital, sales and expense trending. This goes month over month. And you can see that, essentially here's your two gross and net, sales, cost of services or cost of goods, and expenses, kind of how they're all falling in line. And then you'll recognize down here is our balance sheet, essentially assets and liabilities and equity. And here is our profit and loss, income and expenses. So that is, what it's pulling. Now, let's say, for example, gross margin. Let's say, okay, 100% is the average, but we're at 92 and we don't want to discourage our business owner from trying to shoot for 100. So maybe we decide we're gonna set a different benchmark. So we actually have different things we can do up here. We can customize our flags. So right now we're at 92%. So I wanna customize this flag and I wanna say, okay, for gross margin, let's shoot for 95%. Okay, so I can change that here. And then what it will do, as soon as it saves, is it will change my flag. So it's still gonna pull up, oops, I put 95, hold on, let me fix that. Sorry, you don't need to put the point in. Here we go. Just 95, whoa, 0.95. 0.95, there we go. Christy needs to pay attention to the helpers. Okay, so now we still have a flag, but we have put a user-defined flag in of 95%. So we can sort of benchmark it along the way. It'll still tell you what the industry average is, but now it feels more attainable. And once we hit 95, we can move it again and move it again. You can do that for all of these. You can download a PDF of this that you can then send to your client, this is what I send to all of my clients. It's a much more abbreviated version of the Finagraph, but it sure looks pretty. And it's a huge value add for my clients who are sort of in my Cadillac package that are paying a lot. So it just does all of this. This is everything that's in the Finagraph, in chart form, in picture form, a little bit of an ad there. But when I'm sending my profit and loss and my balance sheet, I'm also sending this to them. It looks like I spent hours on it. You saw how quickly I downloaded it. The last thing I love to do for the business owners that actually do want to look at this is you can create a shareable link which pulls them right into this Finagraph with you, and then they can play around with it as well. They can hover over things and look at things in real time. So, is there any questions about what I just showed you? Are we good, Shelly?
Stephen had a question about net profit margin.
Mm-hmm.
Can you show us the net profit margin sort of in detail in the Finagraph? Go ahead and just hover over it.
Sure.
Yeah.
So when you hover over net margin, it's for every dollar, this is like an example. For every dollar in sales, there's 14 cents in pre-tax profit. So possible causes of a low net profit would be that your gross margin is too low or that your overhead's too high. So here's some potential solutions. Now it's worth noting that Finagraph is free for us. It's free. So you don't have to, sign up. I can add as many businesses as I want in my dashboard. I could put every single one of my clients in here. This program in and of itself is free. And it gives you so much insight that even if you're not sharing the actual printout or doing a screen share with them and walking them through this, it gives you some insight. And it's also a great way to just double check to make sure your ratios are right.
Right. And then the net profit margin is the net profit before tax. And that's divided by the sales. So for every dollar of sales, like you said, in this company, they're making 14 cents in profit. Is that right?
Yes.
Okay. Yeah, can you zoom in? Can you do a Control Plus a little bit so we can see the net profit margin just a little bit bigger?
So this is actual numbers here. So my industry average is 10.1.
Okay, cool.
And here's how it came.
Perfect.
I have 0.859% profit before tax over 2.501 in revenues. So my net margin is 34%. So essentially what it's saying is that after you add the overhead back in, we are still gross, or we're netting 34%.
So we don't even have to really know how to compute the formulas with Finagraph, and like it literally tells us how the formula is computed. I want to answer a question about where it's grabbing the information, for instance, from cost of goods sold. So in order, for instance, to do the gross profit or the gross margin, the cost of goods sold is really important. And it's getting that information or determining what accounts go into cost of goods sold according to the way that you've set up your accounting.
Your chart of accounts.
Yeah. And then Joy, I wonder if you can answer this question. Where does Finagraph obtain the industry ratios?
It's a standard benchmarking system that we have, and right now the name of it is totally eluding me. Let me find out from Mike and get back to you on that.
Okay, yeah, it's RMA, and it's definitely considered like the standard for industry ratios. The old-fashioned book, it used to be a huge book of stuff, and then what's really cool about it now is that it's really live, much more current data than what we used to get. So we have just a few minutes left. I want to switch over to Joy. Oh, first of all, I want to say, Christy, thank you very much for taking us in. This was really cool. Love this program. And switch over to Joy, who's going to show us sort of the next generation of what this program can do. If I understand right, it's in development right now. And so if y'all can hang on a few more minutes to this call, you can have some input into how this next generation of Finagraph plays out.
Yes, thank you so much, Shelly. And Christy, that was super awesome Finagraph demo.
I hope I did it justice.
You did such a great job. So I want to set the stage a little bit because, okay, so Finagraph is a financial technology company. We're a high-tech company and a startup. And part of what that means is that things change fast and often. And even just since we shared Flight with the Quick Source group 2 weeks ago, things have pivoted just a little bit. And I'm going to share Flight with you guys in looking at two pieces. One is the basic framework that we're creating, and two is wondering about the content that we're including. So Flight, I'm not going to say that it's replacing Finagraph anymore, because we're finding that a lot of people like the existing Finagraph, and we may not be including all of the existing Finagraph details in the new Flight. So I'm going to walk you through, this is a web app. I'm going to walk you through what it's going to look like. And I can't see any of the Q&A or comments anymore. So if Christy and Shelly could just keep an eye on what's going there and let me know.
Absolutely.
We're on it.
Super. So you've signed up for Flight by Finagraph. You've registered, and here's the groovy screen that you would see. And then you're popped into your activity feed. You're going to add a client, just like Christy showed us, and choose the accounting package. And this links to your client's accounting package and pulls in all of their up-to-date financials. That is really critical because this is where your financial activity feed is getting its content, is based on your client's data. And this is what your activity feed would look like. We have a sample advisor or accountant, Tandy Consulting, in here. And he's just added one client. So he's going to start getting some information here in his activity feed. But before he does that, I forgot, before he does that, he gets to customize his site. This is because later on, he's going to be sharing his feed with his individual clients, and they can see all the same things that Travis Tandy can see. So you get to customize it, and what this does is it ends up looking like everything your client sees came directly from you. This is incredible for your branding. And now we're in his activity feed, and these are some examples of what you're going to see in the feed. And there's different categories. If you see on the left, now the client has changed. It's the little LL icon, so that's a different client. And back up here, we had a CrossFit client, and we had a, I'm not sure what that logo is. Let's call it Brandon Ski Shop. And so here's the basic framework for flight. And what we have discovered already is that this as a framework is pretty freaking fantastic. And people get really excited about it because it's familiar. We all know what a feed looks like. And it's a really easy way to digest what can be pretty complex information. So this would be what you can see, how your clients are listed out once you've added multiple clients in here. And you can, there's a lot of different activities that you can do within this page. And I'm not going to go into too much detail because it's not super critical to what we're talking about. But trust me that there's a lot of functionality here that's super cool. Let's say Travis wants to drill into one client that he's got. He's got, 20 to 30 in here, and he's like, I want to go and check out Brandon's Ski Shop. So he double clicks on Brandon's avatar, just like you would in Facebook. You double click on someone's face and you go into their page, right? Same thing here. And right here on Brandon's page, he's got all of the information about the company, of course, contact information. And you can see over on the right, he's got the refresh button for the financial data. So he can go in here and get the most recent if it's not automatically updating. And that's something that Flight will have, but not at launch, where it's automatically updating. On the left column, you can see shared documents. And this is going to be a drag and drop feature. So Brandon can drag documents into this folder that Travis can then access for different taxes, different things that you guys need. And then also on the left, you can see the connection to the original Finagraph, the more complex piece. Some things that you can do here in your groovy little activity feed. You can comment on the cards, and your clients can comment back to you. And of course, your client is going to receive a notification. And you can adjust which notifications they see. I mean, because sometimes it might get overwhelming. Maybe you just want to do the high alert ones. And so then he gets a notification to go and check it out. So what does your client see when they log into Flight? First thing is they see that it's from you. So they cannot access Flight unless their accounting professional has invited them to join. Again, this is your branding. And then he comes in, you can see in the upper right, we know he's in Brandon's Ski Shop. It's got his name there. But he's on Tandy Consulting's site, basically. And this is where he can interact with his feed and with Travis, where they can comment and collaborate on things back and forth. So that was the framework. That's how the product works. We know that that's really cool. What we're uncertain about and we're struggling with is what content makes sense to show in the feed. We can do activity, and that's basically reporting on the facts of the accounting performance. So, and I'll show you some examples in just a minute. We can do analysis, and that gets into what Finagraph actually does, where it's benchmarking against others in your industry and saying, hey, this is what we're noticing in comparison to the other ski shops. And then the third level is advice, where we're actually, the cards are actually making recommendations on actions. So here are some examples of how those fall into the categories, about how the cards actually would show up. On the far left, you've got super useful, hey, these guys owe you money. And I'm just going to go to the next card so you can continue to see the activity examples. You got paid. We noticed you haven't paid this business and you usually pay it. What's going on? So basic alerts, but super, super valuable. What we're hearing is that this kind of activity update, there's not really an easy way to get that. And so anyway, that just seems like a super useful. The middle column, the analysis, where we're doing a little bit of benchmarking. Hey, you pay your invoices 7 days sooner than others in your industry. Well, that's super useful information. And then the far right column, the advice. To maintain good expense control, reduce expenses by $1,207. Again, could be super useful. My question to our audience, which I would really love your feedback on, and please just write your comments in the chat box. Which makes the most sense to you? What we have heard is that advice could be challenging, because what if it's in conflict with what you're actually telling your client? Analysis could also be, it could be uncertain, because our analysis is not based on an intimate knowledge with a customer. It's based on some benchmarking and their up-to-date financial data. Activity, pretty general and pretty helpful, doesn't get into any of those scary areas where we're stepping on toes.
Is this something, I'm just going to ask a quick question, is this something that the business owner, as far as like the accountant or bookkeeper, could customize as far as what the business owner could see or not see?
That's certainly an option that we're looking at, but one of the principles is we don't want to create more work for the accounting professional. At the same time, we have heard, well, it might be worth a little bit of extra work if I can preview the advice cards and then approve them, and then they show up.
Right, or maybe that you could maybe put your own note on the advice card.
Yep. So you could even maybe edit it.
Mm-hmm.
Yeah.
Someone says, I like being able to see all three and then choose what to share with my client. I'd rather not have them see this because some will be confused and some will freak out.
Mm-hmm.
He likes the idea of the approval process.
Yeah, that makes sense. So picturing, let's just say you've loaded in 15 clients and you're getting, for each of your 15 clients, you're getting maybe 5 cards per day that you need to review and approve. Does that seem heavy, or does that seem like you could just glance at it and click yes or no?
It's probably, Martha's saying it's probably a lot. Tom's saying that he'd want to preview the advice. I don't want it to go directly to my clients without being able to edit the advice.
Yeah. Yeah.
So maybe in the initial setup
Mm-hmm.
of a company, there could just be check boxes like these cards I want to see, these cards my clients can automatically see.
Mm-hmm.
Something like that, maybe.
Yeah.
But I personally think that someone saying probably look and process weekly, that sounds about right. I think once you got used to the feed and how it worked, it would probably be pretty quick for us to go through and go, yeah, no, yeah, no.
Yeah, you're right.
Starting out, there would be a learning curve for sure.
I think you're right. Okay. And so others, if you have thoughts, definitely write them in the chat window and I can take a peek once I get out of this. In addition, I would love your general impression. Does this appeal to you? Does this seem cool? Would you be interested in using it? How often do you see yourself using it? These are all things that we would love to hear from you on. In addition to a little bit of demographics, because I'm not sure, I don't know everybody on the call. I would love to be able to identify you according to, you know, I'm a bookkeeper, I'm an advisor, I've got 20 clients in a year, I've got 4, whatever that is for you. I would love to have that information.
Do you want us to just private that to you then, Joy, in the chat?
Actually, yeah, here's my email address. If you want to just write there, that would be super duper.
Okay.
I welcome your comments and feedback.
And if people want to put it in the chat, and you can private that to Joy if you want, just change the 2 so it goes to Joy, then it will all be saved in the chat.
Oh, awesome.
Yeah.
Thank you for that.
And
Shelly.
thank you very much, Joy. And I think I'm going to go ahead and take over the screen and wrap us up and say thank you very much to everybody for joining us. It's so much more fun when there's other people on the call. And I want to just wrap up by saying that the one thing that you'll do as you're getting started using this with your clients is making sure that your account types are set up right. That's what's going to determine how your feeds work with the Finagraph. And so you'll want to go in there and do that, and then you'll be ready to start using the Finagraph and make the whole job of doing the ratios much easier. Thank you, Chrissy, and thank you, Joy, and really appreciate everybody who came on the call today, because I know y'all and I love y'all. So
Thank you, Shelly.
Yeah, thanks. Y'all have a good one.
Bye, y'all.
Bye.